This is The Wall Street Skinny, a podcast devoted to exploring the financial services industry and making the world of Wall Street accessible to everyone. Hi, everyone. Welcome back to The Wall Street Skinny. This is the podcast that is all about demystifying the world of Wall Street. And we are so glad you're here. All are welcome, whether it's because you want to break into the financial services industry or because you want to understand what your friends or your spouse does for a living, or maybe it's just to better understand what's happening in Succession.
This last week's episode was so good. And I was super pumped because so much of what we talked about in episode 4, our deep dive into investment banking, was in it.
Yes, yes.
You know, they were like negotiating the terms of the Gojo Waystar merger, where again, like terms are important. So
Right.
is ATN included or is it not? But more importantly, they talk about the deal as 50% cash and stock. And hopefully that makes sense to people now.
I mean, listen, Kristen, I'm not going to lie. I'll say that's not exactly what I was paying attention to in this week's episode. I definitely wasn't watching Alexander Skarsgård like struggle to take off his shirt. Didn't notice that at all. In all seriousness, though, I had loved him in True Blood, and I love his dad. Like, I still get chills when I think about the speech in episode 10 of Andor. Did you watch that, by the way?
No, I have no idea what that is.
Oh my God, it's so good. Of all of like the little Star Wars spinoffs, I think it's the best. Like,
no wonder. I have no idea.
I know. You
Okay.
don't love Star Wars. My kids have like little baby Yoda dolls, but I don't really think The Mandalorian is that great. But I thought Andor was awesome. If you're going to watch any of them, I think that's the one to watch. But yeah, like with Alexander Skarsgård, man, like I was underwhelmed by his performance in earlier episodes of Succession. I thought this episode was so much better and more subtle. I mean, like liters of blood aside.
Yeah, seriously, that was a little weird. But no, with his dad, I didn't realize that he was actually like a legit actor. Until I watched Chernobyl. I mean, I know it's a few years old, but oh my God, that is seriously one of the best shows I've ever seen.
Yeah.
It's definitely not a light watch, but it is just really good TV. If anyone's never seen it, I highly recommend. You gotta be in the right mood for it, though.
I know. And like, when are you ever in that? There's so much TV that I'm like, I don't know when I'm going to be in the right mood to watch this, but I really want to when I am.
You haven't seen it?
No. I have,
Oh,
but I'm just
okay.
like, yeah. Like I haven't finished The Last of Us because I'm like,
oh, I can't watch that.
Like
no, I can't watch that. No.
When am I going to be in the mood to watch that last episode?
Yeah.
But Kristen, aside from watching TV,
I mean,
what have you been up to since our last episode?
So I feel like I tempted the universe last week because I joked that I didn't care if I got sick as long as our nanny came in.
Right.
Because the universe was just like, well, hold my beer because I actually got sick. So I felt terrible all weekend. But like, here's the thing. With kids, you can't just like not keep going.
No, the kids do not care that you're sick.
No, they don't. So we had like a swim lesson. We had a birthday party. And then my husband had actually gotten us tickets to this magic show for me and my brother and my sister-in-law.
Magic. I didn't know you were into magic.
Well, no, it's not. But like some of these shows are just really good. And I know it sounds juvenile, but I highly recommend if anyone is in New York City. It's like David Blaine presents Aussie Wind. Anyway, it was really
Sounds
great.
like it's Job Bluth from Arrested Development.
No. This, I promise, I swear to God, like it was so good. But we were initially supposed to go in February, but I was sick then. This is what happens when you have kids.
Right.
So we rescheduled. And then, of course, I was sick again. So we had to go. I just took a Claritin, got myself a Mezcal Old Fashioned, and was able to feel, I don't know, 60% human. It was fun, but I would have...
Kristen, the
preferred,
Claritin and Mezcal Old Fashioned. I got to know what pharmacist you're going to because...
No, well... I mean, in fairness, my sister-in-law is an ER doctor.
That's right.
Not that she gave me the green light for that, but anyway.
Misha, you've now endorsed Kristen's weird drug cocktails.
But no, and then I had to round out the weekend by taking my 5-year-old to the American Girl doll store for tea.
Oh, man, I have been lucky enough to avoid the American Girl doll mania thus far. But also, Kristen, so I feel like now we know who patient zero is when like all of Chelsea is sick next week. Like, I really hope our listeners have been staying away from like magic shows at the American Girl doll store.
No, I know. I'm such an asshole. I honestly really would have just loved to stay in bed all weekend. But I mean, I unfortunately I couldn't. So
dude, I know the drill. We were finally through the worst of our family sickness from last week. And thank goodness, because I think I told you this, my in-laws were in town from Europe all week helping us so that we could get away for a little 3-day weekend to celebrate our anniversary, which was awesome. By the way.
I didn't realize you were there for your anniversary. I thought you just went to Turks and Caicos, like just on a whim.
Just on a whim? Yeah.
I did.
I definitely just jet off to the Caribbean every other weekend. Yeah, no, not so much. I mean, it was great, but back to the real world. And I'm really excited for today's episode.
Well, hopefully that vacation will serve you well, because we are finally doing our deep dive into sales and trading. And I know, Jen, you've been waiting for this for what, like 6 weeks now?
I'm so excited. Okay, guys. So here's the plan for today's episode. All right. Remember how we started in the private markets in investment banking where companies were buying each other, right? And then we bopped over to the capital markets where bonds are originated to finance these deals, okay? So now we've arrived at the end of the life cycle in the sales and trading arm, the public markets, all right, where these securities are now traded. So just like we did with our journey through IBD and DCM, and I'm excited because now we can use these acronyms and you guys know what they mean. So we're going to follow one client and see how they might interact with the fixed income sales and trading side of the bank. So we're going to explain first why they are interacting with the bank. We're going to try to walk you through just a quick example of a trade. And we're going to talk a little bit about like what salespeople and traders are actually doing.
Yeah. And we're also, I promise, we will get into why we called this episode Welcome to the Upside Down. We're actually very proud of that.
We'll explain
that title
as well.
Yes.
And also, by the way, one other thing we will try to talk about if we have enough time, listen, we know this part of the bank in particular is one that has a reputation for churning out people who go on to make some serious money. We'll talk about how salespeople and traders actually get paid. Hopefully we'll debunk some myths. And we'll also talk about what the exit opportunities are for some of these people who are magical enough to make enough money to retire before they're 40. Something you and I clearly haven't figured out how to do.
No. Well, we do have 2 more years. So
Kristen,
there is
your math
that.
is on fire today. We have 1 more year, my dear.
No, I have a month and a half until I'm 18. I have a month and a half until I'm 38. So please don't prematurely age me.
Okay. Also, first of all, it's a month and a half until you're 39, Kristen, let alone 18. I mean, okay. Guys, we're not going to do a ton of math this episode. No, I promise.
I won't.
I originally wanted to do all this. Let's teach everyone how to do bond math in a podcast. And Kristen was like, absolutely not. Okay, so remember from our last episode, right? The fixed income side of the bank deals with debt, okay? Meaning loans and bonds. So who is our lucky victim? Who is going to be our client today that we're going to talk about, Kristen?
Actually, can we back up and get even more basic? Because I think it'd be helpful to run through who are
very basic.
But who are the clients, right? Who are the clients of this division?
Very, very good question. Okay, so I think for starters, the easiest clients to understand are typically clients who manage money on behalf of others. Think asset managers like Fidelity and Vanguard, or hedge funds like you may have heard of Bridgewater or Millennium or D. Shaw, right?
Right.
We're going to start with those.
So in other words, I guess people who take the money that some of us regular people have and maybe like our 401k and help us manage it and grow it over time?
Absolutely. But it is important to note that these are by no means the only type of clients who interact with this division. Some of the biggest clients, we've got bank portfolios, we've got mortgage servicers, which many of you may not have heard of, pension funds and insurance companies, which you've probably heard of, right? And also corporations like our friends back at Amazon that we talked about for the past 2 weeks, right? But all of their reasons for interacting with this side of the bank tend to be a little bit more complex and difficult to understand. So again, we're just going to start with an asset manager to keep things simple.
And actually, this is something I could see my mom messaging me and saying, can you just explain what the heck is an asset manager?
Yes, absolutely. And with that, I think so many of the terms we're going to throw around today are terms people hear all the time and maybe think they understand, but maybe they don't. It's like that old slogan from, what was it? Was it The Real World or Behind the Music on MTV in the 90s, right? You think you know, but you have no idea, right? You never know. You might learn something on a good old-fashioned podcast that helps you clarify a question you always secretly wanted to ask. Okay, but so what is an asset manager? Let's imagine you get paid $100 today. Okay, lucky you, right? What are you going to do with all that money?
Well, I mean, let's assume it's after taxes and you didn't have to earn $200 to net that.
Oh my God, right? You living in New York.
Yeah, but as I see it, right, there's 3 options. You can spend it, you could save it, or you could invest it.
Yes, exactly. And to start, let's explain the difference between spending and investing because they're very different. And that probably sounds obvious, but maybe it's not
Right.
Incredibly obvious until you think about it. Investing means buying something that holds or increases in value versus something that is consumed and disappears. Think about this. Like when I was in my 20s, my favorite food was steak. So I used to measure like all values in units of steak, right? Like, ooh, I could buy that dress, but that's 3 steaks, right? Anyway, so you could spend your $100 on a steak dinner. You pay for the dinner, you eat the food, and it's gone, right? That money was spent.
Yep. I mean, you could also go to Trader Joe's and maybe pay like $5 for the dinner and save the rest.
Okay, yeah, sorry, that was like a really bougie example.
No,
but no, you're right. Like you could put your money somewhere safe.
Yeah.
So, okay, what's safe? Like, sure, you could store it under your, proverbial mattress, but then you have to worry about things like someone breaking into your home or being able to access your money digitally when you use a credit card. Or honestly, in my case, like I know myself and I'd probably just lose it because I can never find my dark keys or my sunglasses or my phone. Like I literally have Apple AirTags on everything, including the remote for the TV.
Yep.
I would probably hide my money from myself and never be able to find it.
Yep.
So
this is why we're friends, because I would do the same thing.
we're like 2 friends, like wandering around looking for our stuff. So, you could put that money that you want to save in a bank.
Right.
And if you recall back to episode 2, we talked through the difference between a commercial bank and an investment bank. You could deposit it at a commercial bank.
Yeah. And actually, I mean, that kind of highlights something that has become very topical now because even that's not safe.
Right.
And so we brought up the bank failure of SVB, right, multiple times. And if you've been following the news, they're discussing this like bailout for First Republic Bank. And so
that's happening like right now.
I know, like literally, exactly. But there is a federal insurance institution called the FDIC, and it insures all deposits at banks up to $250,000 per person per account. But so if you were to go deposit like $100 after you already have the $250,000 in your checking account, well, if something happens to the bank, you then risk losing that incremental $100,
Right,
which is kind of crazy.
I mean, rich people problems. But yes, that's absolutely right.
Or small business. Yeah. Yeah.
Exactly. So, also when you put your money in a bank, you're earning not very much. You're earning nothing or next to nothing, right? Like, listen, now some banks are paying out more interest on deposits in order to incentivize depositors to keep higher cash balances at the banks.
Yeah.
But listen, you're not making your money grow very much, right? It's pretty much just sitting there doing nothing. Meanwhile, out in the real world, every day prices are going up. Last week, right, we talked about eggs going from $3 to $11, inflation, which is something that we're going to touch on in more detail later. Yeah. But the bottom line is depositing money at a bank isn't necessarily a great way to make it grow. Right. So your third option is to invest it.
Yeah. And we talked about this briefly last week, that you can invest your money by buying things called an asset, which hopefully will make your money grow. So maybe you buy a house because you need somewhere to live, or because it's an investment property. So you're betting the price goes up. I mean, you also could buy an Hermes bag or a Rolex, right? Because you're fancy. Or maybe you decide to play it safe and invest in something boring like a bond, which we discussed last week.
Wait, Kristen, speaking of Hermes, by the way, I always think of like when Kyle Richards on The Real Housewives of Beverly Hills, like, didn't she buy like a $95,000 Birkin bag and then like resell it for $330,000? Right? Didn't that happen?
Oh my God.
Dude, I heard that the average annual return in the past few years on a Birkin bag is like 38%. Okay, guys, like for context, okay, the historical average return on the S&P 500, like which is the major stock index that most people invest in, is like 7%.
That's crazy. And I mean, look, most people probably aren't investing in Birkin bags. There's like a multi-year waiting list just to get one. Although, I mean, Jen, like maybe we should be. I think Drake does. He has a whole collection for his future wife.
I guess we've been doing this wrong our whole lives. I mean, listen, maybe we're all morons for not investing in bags. I personally don't get it. I mean, if I can't carry it in this like little magnetic wallet on the back of my phone, it is dead to me.
I mean, who's buying a $95,000 bag and actually taking it out? I'd put it in a freaking glass case that nobody can touch, or like it's not going anywhere.
Right, exactly.
Like it's sitting in my closet.
If it's going to appreciate at 38% year over year, you bet it's not going anywhere.
Yeah.
But yeah, so normal people, like the rest of us, most people are just trying to find assets to invest in that they think are likely to appreciate in value.
I mean, unless you're like me, I'm still traumatized from 2008. So I'm just trying not to lose money. Well, I just wanted to
exactly right, Kristen. I mean, what you're talking about there is risk appetite, which is exactly what we're going to get into here in a little bit. Most people are trying to find something to invest in that is either going to go up in value or at least just preserve the capital that they invested in the first place. And so how are you going to do this? Like, you can try to do this all by yourself, but most of us aren't experts in investing money. Pretend you're, I don't know, a podcaster, huh?
Jen, are you a podcaster with the number 5 podcast in the career categories in Lebanon?
That's right, baby. But yeah, listen, let's say in this hypothetical example that some wonderful genius decides to give you your first podcast sponsorship and pays you $100, okay? Listen, you're too busy podcasting and trying to monetize your podcast to figure out how to invest that $100. So you give the money to an expert. You give your $100 to an asset manager and they invest it on your behalf. You pay them a fee to make your money grow. So how do they do that?
I'm guessing you want me to say by investing in things.
There you go, right?
There
Bingo.
we go.
So listen, to simplify this massively, they can help you do this by, buying things with your money that either pay you at regular intervals, think interest payments on bonds or dividends on stocks, which we'll get into a later time, by buying things that go up in value so you can sell them at a higher price than you bought them for, or some combination of both. And a number of factors are going to determine your investment strategy. For example, how long do you want your money tied up for? Do you want to spend it next month? Or are you willing to lock this money up until you retire? Again, when we're 40 in 12 years or whatever.
I know my math, it was pretty bad, but that's okay.
But the number one factor that determines how your money is going to be invested is what is your risk tolerance?
Yeah. And actually, the general theory is that when you're younger, you are more likely to take more risk because if things go badly, you have more time in life to make that money back. And so, for example, as a young person out of college, you probably are willing to put money in more risky investments. And maybe you should, right? Like equities or maybe Bitcoin. But if you're approaching retirement, you want to invest in the least risky things possible because you're not planning on working that much longer. And so you're not going to be earning money that you can live off of for the rest of your life.
Right.
You need to live off of the money that you're earning from the actual investments.
Exactly.
So,
By the way, I loved your example of like kids fresh out of college buying Bitcoin. Like, who are you people and where are you getting all your money?
Yeah, seriously.
But yeah, listen, we'll get into personal finance strategies at a later time, but that's the classic theory, right?
Yep.
So, okay, you might take your $100, give it to an asset manager, and use it to buy into a mutual fund. And the analogy that I always use is a mutual fund is kind of like a shopping cart. So depending on your risk tolerance, it's like going grocery shopping. Sometimes you're shopping for your whole family for the week. So you need some veggies, some fruit, some meat, some dairy, some pasta, like whatever people are eating these days. I mean, Kristen, you and I grew up with like the twisted food pyramid of the 90s where it was like, oh, you're supposed to have a breakfast of like milk, orange juice, a bowl of cereal, also with milk, like 2 pieces of toast and a stack of pancakes. Like it was so
Jen,
insane.
You are describing my 5-year-old's diet. So I like to joke she's like Regina George in Mean Girls. I can't go to Taco Bell. I'm on an all-carb diet.
Oh my God, that's a great movie, and I love your daughter. But yeah, sometimes you're taking a little bit of something from every aisle. Sometimes you're like, screw it. We are shopping for, I don't know, like only cakes, right? We're going to go nuts and get all the cakes and pies and cookies in the store, and that's it. Sometimes, on the other hand, it's like, I don't know, like the week after Thanksgiving and you feel sluggish and gross from everything you've eaten and you're on, I don't know, a health kick or God forbid, like some fad diet and you're stocking up on only like celery or grapefruit or cabbage or whatever.
No. I mean, I know I joked about Regina George, but please don't get me started on fad diets. And actually, side note, if anybody wants to learn about why diets don't work, there is a podcast I love called Maintenance Phase, which basically debunks all of these. And it's called Maintenance Phase, by the way, because pretty much all diets are not sustainable. And while they might seem to work at first, they basically go to hell in a handbasket in the maintenance phase.
Yeah,
so,
I listened
check that
to
out.
that one in your recommendation. I liked it. Okay, but back to our analogy. So you know where I'm going with this, right? Investments
I'm not sure.
are like groceries, except you're not catering to your physical appetites and your physical health, but you're making choices based on your risk appetite. Yeah.
Okay, so I get it. So you're using the food analogy because of the appetite.
Exactly.
Got it.
You are making choices based on your risk appetite for the sake of your financial health.
Okay. Now I see what you did there.
Yeah.
Just got it.
Yeah.
A little slow, but that's okay.
Also, now I'm hungry after talking about all this. But anyways, if you are just looking for a long-term investment strategy that should track the performance of the overall market, that's like our analogy of doing your family grocery shopping for the week. You're going to take your $100, you'll go to one of these asset managers, and you'll buy into a mutual fund that invests in a diversified basket of assets that all have a varying degree of riskiness. You make some money here, lose some money there. You're not likely to get wiped out from one second to the next. next. And your money should theoretically grow steadily with time.
Actually, let's get into the riskiness or the relative riskiness of the different investments.
That's
like
a great
not just
question.
the food, but the actual
exactly.
investments themselves.
Less food, more investments. So all investments carry a degree of risk with them. Okay. If there was 100% foolproof guaranteed way to make a ton of money, I don't think you and I would be here right now, or we'd certainly be doing this podcast from like a beach in Hawaii with like Mai Tais.
Yes.
Okay, so the varying degrees of riskiness of investments. We'll start with stocks, okay?
Right. And stocks, by the way, just as a recap, are ownership shares in companies, and they tend to be the most risky.
Right, exactly. You buy a stock and, ignoring dividends, we'll get into those later, but either the price of the company goes up or it goes down. You hope to buy at a low price and sell it at a higher price at some point in the future. Great, cool, awesome.
Yeah. And so we're going to just jump back to like Amazon from last week. So if you had, say, bought $100 of Amazon stock like 10 years ago, it was trading at $15 a share. Well, today you could sell it for like $105 a share. And so you would have turned your $100 into $700, literally multiplied it 7 times in 7 years.
Yeah.
So that's
dude, if you bought Amazon stock 10 years ago and held it all this time, you're probably feeling like a hero right now, right? But what if you bought, I don't know, Bed Bath & Beyond stock instead that year? It was trading at like $70 a share 10 years ago. Okay, guys, Bed Bath & Beyond just declared bankruptcy this past week. Those shares are now trading at 20 cents a piece. So you would have taken your $100 investment and wiped out all but 30 cents of it. Okay, so unfortunately, I'm not feeling like such a hero in that case.
Well, I would say hopefully you sold before it got all the way down to 0.
I mean, who knows, right? Sometimes these things happen really quickly, right? The point
true.
is that when you invest in the equity market, you can very well lose your entire investment. Because of the way that capital structure is organized, equities are the riskiest investment that you can own. And bonds, meaning debt instruments, right? Those tend to be much less risky. They are higher in the corporate capital structure, and debt holders get paid back first in a bankruptcy.
Yeah. And so just to clarify, if a company goes bankrupt, contrary to popular belief, everyone who's invested with them doesn't just get completely wiped out. So like Bed Bath & Beyond, if you were a debt holder and you invested $100, you might actually get, say, 70 cents on the dollar back, depending how things go.
Right.
But if you own the stock, the chances are your $100 is entirely gone. And PSA, if you happen to have a Bed Bath & Beyond gift card, or Bye Bye Baby, I might add, rather than become an unsecured creditor, please go spend that money now. You actually have until, I think it's like May 8th to use it. So
saving the world one Bed Bath & Beyond gift card at a time. Okay, right. So as a bondholder, over time, you're usually collecting coupon payments that compensate you for tying up your investment in this company, in this debt, right? Except again, in the case of a zero coupon bond, which we're not getting into now. But the goal here is still to just buy bonds at a low price and sell them at a high price, just like with equities.
Right. And I guess back to the grocery store analogy.
Yeah, dude.
Does this mean that the equities are like the chocolate cake and bonds are like the vegetables? So boring but necessary?
Yes. Listen, we're oversimplifying here, of course, but that's how I'm trying to explain the relative riskiness of these investments, right? There's a whole spectrum of riskiness, but generally speaking, again, equities, riskier. Debt, less risky when it comes to preserving your original $100 that you started out with. So, okay, our asset managers are going to offer different mutual funds that vary according to the risk exposure that you want to achieve. Maybe you want to risk all $100 on, I don't know, a lotto ticket, right? Betting on a couple of companies, and maybe one hits it big. That's our chocolate cake, right? There's a very real risk that this money gets totally wiped out. Maybe there's something in the middle where you take your $100, you invest it in a fund with a diversified exposure to the overall market. That's our weekly grocery cart, some stocks, some bonds, a mix. Or maybe you're very nervous about losing your $100. So you want to put it just in super safe stuff. Stuff you know you might make a relatively low rate of return on, but where you stand a very good chance of getting that original $100 back at the end. Okay, let's call it our, I don't know, like let's not say celery because no one likes celery, but like let's call it our broccoli. Okay, so in that third example where we want to keep our money very safe and boring, but still make it grow, those actual investments are going to be likely debt instruments and likely ones with a low risk of default, such as, I don't know, bonds issued by the U.S. government that we were talking about last week, right? Remember we touched on U.S. Treasuries for a bit?
Yeah. So those are bonds, right, issued by the U.S. government that fund everything the government needs to do. Because the U.S. government can print money, they stand a very low risk of defaulting on those bonds. Well, I guess assuming the government can work out this whole debt ceiling crisis thing,
Exactly.
but details.
Okay, so now back to our asset manager. They have millions of customers just like you who are all investing their money with them. It's not just you taking your $100 and investing it. It's pooled together in giant amounts of money. So it's millions or hundreds of millions of dollars at a time. Investors tell that asset manager generally how they want their money allocated based on that risk appetite. And so let's try to start talking about a trade that we're going to do to express a view. So, okay, right. First, we have to set the backdrop. We need to do like a wee bit of macroeconomic theory here to set the stage. So we'll try to use cool voices like this to make it exciting.
So it is the spring of 2023.
Drama.
High drama. But no, so we have found ourselves with a very real risk of recession right now. So meaning slow economic growth. SVB collapsed and people are worried about the banking sector in general. So multiple banks have been downgraded. We just talked about the bankruptcy of Bed Bath & Beyond. There's like layoffs being announced nonstop. I feel like this is like now turning like a little depressing. But
That's okay. Whenever we're talking about bonds, we like to be depressed.
But so people are worried. And there's also obviously a lot of talk of the Federal Reserve. And I guess, Jen, like, why is that?
Well, yeah. So who is the Federal Reserve, or the Fed, as we call them, right? And that's not an acronym. It's just an shortening. I just make sure everyone knows you don't capitalize FED. I see that a lot. They are the central banking system of the United States, and they have the dual mandate of maximizing employment levels without overstimulating the economy and causing runaway inflation, meaning prices going higher out of control. And the Fed, like, everyone thinks they're omnipotent, but they only actually have a few tools. And one of them is the federal funds rate. So that is the rate that's set for commercial banks to borrow and lend money overnight. And so listen, over the past year, in response to high inflation, there's been a lot of talk, and we've seen it happen, where the Fed has been raising rates to cool growth and investment.
Yeah. But now it's logical to think that the Fed might stop raising rates, or maybe even lower rates, to stimulate business activity, help the economy sort of grow more.
Exactly. So, okay, so back to our grocery store analogy, it might make sense that everybody really wants broccoli right now. The safe stuff. Yep. So you see what's going on with everything you just talked about, Kristen, right? Bed Bath & Beyond and First Republic Bank. And you're like, man, I really don't want my money to get wiped out investing in risky equities.
Right. And so you and other investors want to continue to make your money grow in the safest way possible. And so investors want to own assets that will outperform when everything else is going to hell in a handbasket. And so they want to own assets that should go up in price, even if the Fed decides to lower rates. And so what assets are those? Well, they're bonds.
Exactly.
So the asset manager would buy something to express the view that rates are going down.
Yep. So back to our analogy one more time. If the mutual fund is our grocery cart, okay, the global financial markets are the grocery store. The sales and trading arm of an investment bank is how you gain access to the grocery store, okay? Now we are talking about the public markets where those bonds are actually traded. And guys, I promise, I've almost exhausted my little analogy, but each trading desk in the sales and trading arm specializes in a different product that trades in the public markets. So just like you have your deli aisle and your dairy aisle and your baked goods and your fresh produce, right? You have your treasury desk, your credit desks. You've got all of your derivative desks, right? Swaps and options. You've got your agency desk, your mortgage-backed securities desk, your FX desk.
Lots of desks.
Yeah, exactly. And your commodities desk.
Yeah, don't forget about them. The bank that we used to work at, they were like off in a different city. But
I promise you, we won't forget about you guys and commodities.
No. So back to the asset manager. So let's say Fidelity, they're ready to put on a trade and express this view. So Jen, like, what are they going to do first?
First, Fidelity is going to call their salesperson at the bank, and they're going to talk through the view that they want to express.
And can you explain, like, what exactly is the salesperson? What are they doing?
Very few people actually understand what this means. As a salesperson, you are basically a dedicated consultant for your client, specializing in certain products. You aren't like hawking those products. It's not like I'm trying to get you to buy something you don't already want to buy as a salesperson, right? I'm not pushing like Kardashian weight loss tea or whatever. For the most part, I'm listening to your needs and your objectives, and I'm making recommendations to try to help you accomplish your goals. As a salesperson, you talk about the products you specialize in all day with your clients. You're going to help them, analyze movements in the markets, and you're going to share what we call color, which is basically just insight about the types of trades that we are seeing happen from other clients in the markets. Sometimes if you're really good, you'll propose a trade idea based on research you've read or from conversations you've had with the trading desk. Guys, I sucked at trade ideas when I was a salesperson. But ultimately, you end up then liaising between the client and the trading desk at the firm to actually help them put on trades.
Okay. And so do all clients have an individual salesperson for each of the products you mentioned? Or how does
great
that
question.
work?
No, typically no. While traders are very specialized at the banks and tend to trade only one product at a time, sales coverage tends to be based on groups of products that share similar characteristics. So at most banks, the 7 or 8 desks I just mentioned earlier might be covered by some combination of maybe 4 salespeople. Okay.
Got it.
So yeah, you've got all the rates products together, typically credit all together, and then FX kind of off in its own world.
And then the commodities guys.
Oh my God, I forgot commodities again. Okay. Yes.
So commodities, by the way, is like think oil and gas and gold, right? So those are grouped together within the fixed income division. And they, I assume, are going to have like their own salespeople since they were off in a different city, like we talked about.
So listen, by the time I left the trading floor, by the way, a lot of banks were increasingly moving to the role of like macro salespeople who could cover one client across pretty much all areas of fixed income. Honestly, I'm not sure how successful that model ended up being because like you can't be an expert at everything. It was probably like just another misguided cost-cutting operation. But yeah, so most of these products typically share similar characteristics along some technical lines. It's very reasonable to switch in your career from specializing in, say, like interest rates to, I don't know, mortgages, right? Fluidity across different desks can actually be a very big asset to your career long term.
Got it. No, this is really interesting. I never understood what salespeople did. So like, I was like, what are you doing like day to day? But it does seem like in a lot of ways, they do resemble what investment bankers do, I guess, since they're consulting with their clients.
Oh, 100%. You are trying to stay in front of your clients all the time. You're taking them out to dinner, not because, everyone just likes drinking martinis, but you're building those relationships. You're talking to them on the phone and you want to be the first person they talk to whenever they need to do a trade. Actually, true story. So at the last firm I worked at, they installed this client relationship management software for everyone in sales. And it was kind of this like
CRM.
Yeah, CRM, exactly. And it was kind of like this big brothery thing, but we didn't know it at the time. So it was tracking every incoming and outgoing call, every email. It was literally tallying up how many minutes we as salespeople were spending on the phone with our clients all day. And unbeknownst to us, management was keeping track of this. And at the end of the first month, they like published the results. Like, here's your rank in your division based on how much time you spent yapping on the phone. And guys, in case you can't tell, I love talking on the phone. So even though I wasn't that good a salesperson, I had like the second most cumulative minutes on the phone in like the entire division.
That's awesome.
But the reason we were doing that and the reason they cared about that is because, again, the way I see it, it's really hard for you to hang up on the phone with me and go call someone else to do a trade. If you're already on the phone with me and you need to do something, you're like, I might as well. Right? I'm too lazy to go call someone else. Right. So that was like a little bit of my strategy. But yeah, so I mean, the tricky part of being a salesperson, unlike a banker, even though you're both consultants, is that salespeople also have to balance trying to help their clients achieve their objectives and make as much money as possible while helping their trading desk. The people who's charging those clients money to put on trades, you're also helping your trading desk make money, right? So you're constantly walking this tightrope of keeping everybody happy, and we'll get more to that later.
You know what that sounds like?
What?
I kind of feel like it's one spouse trying to kind of appease their partner while keeping like the in-laws happy. So my husband, I mean, I think everyone gets crazy sometimes, but I've been known to have some like irrational fights with his parents where I might be a little unreasonable. And by the way, I love his parents.
Love the Haggertys.
Yeah, no, they're the best. They're actually in Mexico right now, but I'm not jealous at all. So whenever we've had arguments, if he's trying to mediate, he has to come across like, he is 100% on my side, while also being like, don't worry about it. So I try to appease them. It's
Keeping
like
your
this
spouse and your in-laws happy is a tightrope to walk, man. Yeah. Okay, so back to our example. So Fidelity calls and tells you, their salesperson, they want to express the view that rates are going to go down. Okay, so there's a number of different ways to express that view. The way that you express that view as a client, too, is going to depend on your actual mandate, right? Like what you're supposed to be doing all day.
Can you get into just like the mandate that these different clients have?
I mean, listen, everyone's kind of charter as an asset manager or as a hedge fund, they all have the purpose of making money. But how they make money is a function of the way that client is set up. So hedge funds, for example, relative to say traditional asset managers, they are highly levered. They have a very different fee structure, and they oftentimes have the flexibility to employ very different investment strategies. So when we talk about clients, since we can't use specific client names in the real world, we can't be like, Fidelity's doing this. Right. When we're giving people color, we use this kind of cloak and dagger classification to group them by the different types of mandates they have. So for example, we call traditional asset managers, we call them real money, because when they're buying $100 worth of bonds, that's typically almost all managed money being put to work on essentially a dollar for dollar basis versus say, a hedge fund, right? They employ a ton of leverage in their trading. So when they're buying $100 worth of bonds, that might really only represent like $20 worth of capital being put to work, right? So we call them fast money. They tend to be in and out of trades. They can have more leverage. They can take riskier views. Again, there's a ton of other types of accounts with different little, code names.
That's
we'll
cool.
Get into that another time.
No, I love that. I had never heard that term before. So that's so interesting.
Okay, so back to Fidelity. As a salesperson, I'm going to discuss with them, and by them, by the way, I probably mean a portfolio manager at the fund, someone who is making decisions about how to allocate the money in that mutual fund. Yep. I'm going to be talking to them about the optimal way to express their view that rates are going to go down within this fixed income world.
Got it.
They want something low risk that makes them money in a world where the Fed might be lowering rates. So I might say, hey, why don't you buy some U.S. Treasury bonds? We've talked about those enough, guys, right? Those are super safe. And they might say yes, or they might say, no, I want something else. Maybe with a slightly higher interest rate than a Treasury. So we'll discuss, different products with various maturities. We'll talk about relative value, what looks rich or cheap. And then maybe in a miracle, because we want to tie this back to our previous two episodes, they're going to say, hey, I want some of those fabulous Amazon bonds that you issued in the capital markets division.
They're now trading.
That's right. Our baby bonds are out in the world. They're all grown up. They're legal to drink. But yeah, so we're all gonna agree on the strategy, and now we have to actually execute the trade. Okay.
How does that work? How does the actual execution work?
I know you guys are gonna be devastated to hear this, but this is where my grocery store analogy has finally reached its limit. Okay. So there isn't just $1 million worth of broccoli lying on the shelf or $100 million worth of broccoli lying on the shelf, depending on the trade size. Our asset manager needs someone to sell them $1 million worth of bonds. Now, remember, Amazon issued $13.7 billion worth of these bonds. But when they did that issuance, all of those bonds went into some pretty strong investor hands, right? Those bonds are all locked up in somebody else's account. They aren't just floating around waiting for someone to come buy them. There's only a handful probably that are free to trade in the secondary market. This is weeks or months or years after that new issuance process happened, right? So who are they going to call?
Ghostbusters.
Right?
The trading desk.
The trading desk. Okay. So in this case, it's going to be the high grade credit trading desk in the fixed income division of an investment bank. So remember I said we have all these different desks specializing in different fixed income products, right? So Fidelity is going to call me, their sales coverage at an investment bank, and ask me to offer them $1 million of that 6% coupon Amazon bond that was issued back in the capital markets division a few months ago.
Yep.
Okay, me as a salesperson, I'm going to now ask my trader who specializes in that type of credit to make a market, meaning they have to be the seller for this buyer, even if they don't want to sell these bonds, or even if they don't just have them lying around, okay? They are going to have to take risk by agreeing to sell the asset manager those bonds at one price, and then they're going to frantically turn around and try to buy them back at a lower price and make that differential.
Got it. And so that's then how they're making their money, right? By agreeing to sell things at a price they know is higher than the price they can ultimately buy it back for.
Yes,
correct?
that is one piece of it for sure. And as always, we're oversimplifying, but yeah, they are making money in tiny clips like this all day, every day by capturing the spread between buying something at one price and selling it at a slightly higher price. And that's called the bid offer spread. Okay. The spread in between prices where something can be bought, AKA bid, and something can be sold, AKA offered.
Got it. And so just like I like numbers, so kind of like we did last week. So they would buy it at 98 cents on the dollar and sell it for 100.
You got it. And listen, depending on the liquidity and complexity of the product, that bid offer spread it might not be $2. It might be 2 cents. It might be $20. It's either going to be very wide or very narrow. Traders will charge more for risk that is harder to hedge and less liquid. And for liquidity, if that's not a term that you're used to thinking in, think of either, a giant ocean, right? Or a tiny puddle. Okay. That's how we think of liquidity. Some securities are, trading constantly all day in huge sizes in relatively minor price movements because they are very liquid, right? They'll only have big gappy price movements if new information comes through that, moves the market in a big way.
Yeah.
Something like 100 million 10-year U.S. Treasuries under normal circumstances, that's actually a pretty standard institutional trade size. And it's relatively easy for a Treasury trader to find another seller in the market to buy the bonds back from and cover his or her risk at a profit. But by comparison, $1 million worth of Amazon bonds, since we know they only issued 13 billion total, that actually might be hard to source. And you might have to charge more to hedge yourself as a trader.
Got it. Actually, can you just explain for listeners the term hedge and cover? I think that those are things that people might not be familiar with.
100%. So the term hedge just means neutralize your risk or offset your risk. And we'll get into more of that in a second. Let's go back to the term cover. In a later episode, we should probably get into the mechanics of short covering and leverage and how all that works. But for now, let's just establish that you either own something or have exposure that replicates the cash flows of owning something. And that is called being long.
Right.
Or you have sold something you don't yet own. That's the key thing. Or have, again, replicated those same cash flows. And that is called being short.
Yeah. And actually, I want to jump in and just to be really clear, because this is confusing, but just because you're selling something, that doesn't mean you're necessarily short.
Right. Exactly. If you're selling something you already own, you're just getting less long. Right. The critical differentiator with a short position is that you do not yet own the underlying instrument.
Right. And actually, to go back to sort of everyday things that people might deal with. So if you were, say, looking for a house, you are implicitly short the housing market because you want prices to go down so you can buy it at a lower price, right? So, but then after you buy a house, now you're long the housing market because you're probably cheering when the market goes up because you want to be able to sell your home at a higher price.
You just went through this.
Yeah, I literally just flipped positions on this last week. We used to open up our Zillow app, be like, yay, there was a price cut. Whereas now we're like, no, we want to see the price go up. And so our friends at Fidelity, right, they just got long $100 million of these Amazon bonds by purchasing them.
Just $1 million.
$1 million. Oh my goodness. Our friends at Fidelity just got long $1 million of these Amazon bonds by purchasing them from the trading desk at the bank. And so, they want rates to go down.
Exactly. The bank, on the other side, what they did was they made a market, they took some risk to facilitate this trade, and now they're off attempting to cover their position at a profit.
Right. Last time we're going to recap this, but I think it's a really critically important point. There are two main views that people can express in any market, which is long or short. And so if you're long, you want the price of the asset to go up. And if you're short, you want the price to go down. And just for fun, if anyone was watching the saga with GameStop a few years back, there was actually a bunch of hedge funds that had expected the share price to drop because just the fundamentals of the actual business model, didn't seem that great. It's
who's wandering around in video game stores.
Exactly. And so they shorted a ton of stock. However, then there was a bunch of retail investors, which is just like you.
It was
and me.
Activist investors on Reddit, right?
Yes.
Some Reddit group.
Yes, this is, I think, one of the meme stocks or whatever. And so all these people were buying GameStop stock. I think it was on Robinhood or whatever, and getting long. The price kept going up, and these hedge funds ultimately got blown up. They ended up losing a lot of money. And that's actually something with being short is that you have unlimited downside.
Yes.
It is actually incredibly risky. I don't think people understand shorting stock, very risky.
Absolutely. But let's hold up. Okay, we'll get into hedge funds down the road.
Yes.
And listen, with stocks, it's easy, right? Is the number on the price going up or down? And not to belittle stock traders. This is incredibly complex. Don't get me wrong. But the tricky thing about debt, okay, and this is why we call it the upside down, is that the relationship between price and yield is inverted. Yeah. If I buy this bond with a 6% coupon, my Amazon bond, right? If I buy it with a price of 100 and market rates go down, meaning the market rate for a security of that same maturity goes to say 3%, the price on my bond has just gone up because I'm receiving 6% in a market where everyone else is only receiving 3%, right? I'm a hero for receiving that above market coupon.
Right.
And that's why when we're actually talking about the fixed income market, we say that rates rally. Rally gives us that vocab word to indicate that rates are going down and prices are going up without using up or down, because that can get confusing. And the same is true in reverse. If I bought that bond with a 6% coupon and rates go to 10%, my POS bond is going to trade at a discount because I could be getting a much higher return on my investment by lending money at the now higher market rate. We call that price action selling off because, again, it's just a better way of saying rates went higher and prices went down, right? It's too confusing otherwise.
Yeah. I need to start getting in that lingo because, last week I said it incorrectly. So I don't
know if I noticed.
Well, that's good. But anyway, so our asset manager here, right, has back to the asset manager. They've just gotten long the interest rate market by buying these bonds. Right. And so they have expressed the view that rates are going to go down in the future. Yeah. This is the upside down. So,
so the cool thing is, remember, I mentioned all those other desks, depending on a variety of factors, namely your risk tolerance, but also like your balance sheet, your mandate. You as a client can express this same view in so many different ways. And, I don't want to confuse everyone by getting too technical here. But listen, with that Amazon bond, you could just isolate the credit component of Amazon's bonds by doing something called an asset swap, which is what a lot of people who play in the credit market are doing. You could use instruments called swaps and options to express that just long duration view that we were talking about there by getting long the market with the view that rates are going down. I mean, there's a ton of different ways to do it throughout the fixed income.
This stuff is definitely, I think, a lot easier with visuals. I feel like it's tough to grasp here in like a casual podcast. So we definitely will be sharing this once our YouTube channel is up and running.
In like 20, 30.
Yeah, it's going to be in like 10 years. But Jen does have a ridiculous TikTok video about some of the terms. If you want to see the Greeks on the pricing of these derivatives.
That's like our worst performing TikTok video, but I like secretly love it.
I love that. It was
okay.
Great.
So the bottom line is that the traders of all these products at a bank, they all specialize in making markets in these specific instruments. The great thing about the fixed income world is that once you understand the basics of bond math, this, price up, yields down thing, you can use that knowledge to move throughout other desks. You like treasuries? Okay, cool. Try your hand at swaps. You like swaps? Well, why don't you go trade options on the vol desk, right? Whatever product you're trading, you take risk to provide a buyer for every seller and a seller for every buyer. That's it, okay? So, I mean, again, all we're talking about here is just locking in bid offer spread day in, day out.
So wait, but is that, you said there was like other ways to make money.
Yeah.
Right?
Oh, absolutely. So listen, in the course of market making, oftentimes traders will make strategic decisions not to perfectly offset every flow. They too can take views to some extent. So let's say Fidelity bought those bonds and put our trader in a short position. He or she might have the opposite view from that asset manager and think that instead, maybe I don't want to own these bonds for whatever reason, right? He or she might just stay short that particular bond. Or let's say he knows that, all right, while this kind of asset manager is buying this type of bond like crazy, there's another type of client that's actually selling these bonds. Maybe hedge funds taking profits from already having been long, right?
Right.
So you might wait to cover your short, knowing that you can source that risk on the other side. And as time goes on and more of these trades happen, traders build a book of existing positions. Right. They aren't just taking naked risk and expressing views as their primary function, right? Their primary function is making markets for clients. Right. But their trading book is going to end up generating profits for them as well.
Right. And actually, I think it's worth mentioning that traders can't just take this naked risk all the time, like a hedge fund, say, could, because there was rules put in place after the crisis of 2008, because basically the regulators didn't want to risk depositors. So again, you and me who have money with these banks and have those get risked because the traders are trying to express their view. Like that's not their core mandate. Like that's not what they're supposed to do.
But it's impossible, and it's also very expensive, to perfectly neutralize a trading desk exposure at all times, right? To perfectly hedge it out. And that's what I'm talking about there with hedging. Traders can't and won't perfectly offset every purchase with a sale and vice versa, right? Either because, listen, sometimes there's not a perfect offset for the product you just traded because it's really specialized and really exotic or really illiquid. And so with that trading book, that's going to make and lose money with movements in the market. The profit and loss, so what we call P&L, really creative, I know. The P&L of those positions combined with the profit or loss associated with facilitating client trades, that's the money the desk makes. Yeah. At the end of the year, traders are evaluated by the total amount of profit they bring into the bank through this combination of market making and position P&L.
Yeah. And actually, before we get into the compensation, can we actually just touch on how you decide which desk you want to work on in sales and trading?
Yes. So the awesome thing about the fixed income division, I think I touched on this a little bit earlier, but it functions a lot more like one giant group with lots of little subgroups. You're going to get to know just about everyone on the trading floor, and you should be able to kind of flex into and out of most desks on the floor when you're just starting out.
Yep.
So your decision as to which desk you end up on is going to depend on, a lot of what's best suited to your personality and what actually interests you, right? Similar to the fit questions we discussed in the investment banking world, right?
Right.
Do you like simpler products that trade in high volume all day, every day, like treasuries? Or do you like more complex product that trade less frequently, like, exotic options?
I feel like treasuries aren't exactly super simple.
Absolutely true. I mean, by simplicity, I just mean that some products have more moving parts than others.
Makes sense.
Listen, if you like thinking about and reacting to the big picture stuff, the macroeconomic stuff, maybe you like treasuries. Or, some people coming in, like I know you, Kristen, you started in a complex structuring group, right? Like you might like getting into the weeds a little bit more with products that don't react so much to intraday moves in the market and have more of a project-based timeline. And again, we're not talking about a project-based timeline like an IBD where you might work on something for a year and nothing ever happens. We're talking about a few days or a few weeks maybe. But listen, as with any other part of the bank, we can't say this enough. The most important factor will be how your personality fits with the people in the group, okay?
Yes.
This trading floor, it is a big open football field with rows and rows and rows of seats, okay? You are going to see and hear and smell and talk to these people all day long, so you better like them. And listen, because the lifestyle and structure of sales and trading can be a little bit more sustainable than kind of the 2 years up or out like you have in investment banking, you need to look around and think, hey, can I see myself in that senior person's shoes in 5 years? Are they going to be a mentor and an advocate for me?
Right.
And finally, what desk is going to set me up for like the best money-making opportunity? And what exit opportunities tend to stem from that?
Yeah. And let's definitely touch on that later. But it does sound similar to banking, maybe with a little more fluidity between the groups and more longevity for individuals who decide to stay in their career. And so, look, the other question, which is I feel like always on people's mind, is trader compensation.
Yes.
So is that just tied to how well the product performs over the course of the year? Or like when people say the market is up or the market is down, is that good or bad? How does that all work for the trader?
Traders' compensation is a measure of how well they traded the asset class they specialize in, not just how well that asset class performs. Like, did prices on that asset class go up or down, right? If traders were just only getting long an asset class and that was their whole strategy, they wouldn't last very long. No. So just like everyone else at the bank, traders and salespeople get paid a nominal base salary and then performance-based compensation, aka a bonus. And you guys know how I feel about that term. I think it's a misnomer. They get paid that bonus at the end of the year. You as a trader are given a budget every year in P&L, hopefully P, and you're compensated in correlation to your performance relative to that budget. So if the desk's budget was $100 million and you only made $50 million, the bonus pool not going to look so good that year. It's going to be greatly reduced, right? Conversely, if the budget was $100 million and you just totally crushed it and made $200 million, you are much likely to have a higher individual bonus payment.
Right. But you don't get paid out like a huge portion of that $100 million profits, right?
Sadly not. Yeah, that's an important distinction. So those profits at one trading desk, remember, they're combined with the profits or losses at all of the other desks within that division. Right. So listen, let's take like the interest rate and the credit trading desk and the mortgage desk, right? They're all in the same fixed income division.
Yep.
If interest rates and credit had an awesome year, but the mortgage desk just totally fell apart, right?
Yeah.
The profits from the desk that made money are offset by the losses at that other desk. So you may have had a great year, but the beta, meaning the correlation of your individual bonus to your individual trading P&L, it's just not that high.
Okay, and we got this question on TikTok a lot, which was, what about the salespeople? Do they get paid a commission? Like, how do salespeople make money?
Yeah, so they do not get paid a commission, at least at the institutional level, like we're talking about here. Remember, salespeople are consultants and facilitators. They are not in the business of taking risk. They are in the business of maintaining client relationships and getting those clients to trade with the trading desks. So salespeople don't directly make money for the bank, but they create money-making opportunities for the trading desk. Yep. So those money-making opportunities, the risk that the salespeople bring in through their clients is quantified via a point system, and that's called sales credits, okay? It's basically funny money that's tallied up with each trade. It's attributed to the salesperson who brought in that trade as basically a measure of your performance, not just, how many minutes you spent on the phone. So just like traders, you as a salesperson have a budget for sales credits every year, and you're expected to either hit that or exceed it. Okay.
Right.
And there does tend to be a correlation between your sales credits and your performance-based compensation, but it's a much lower beta than the traders because you're not the one actually taking the risk. Okay. Like with everything else we've said today, higher risk, higher reward. And I think this kind of elegantly brings us to the topic of
exit opportunities.
Yes. So listen, for traders specifically, there's a pretty clear path to exit to the buy side into other trading roles at clients that you've built a relationship with over time. As a salesperson, when I'm taking my clients out to dinner, they want to talk to me, fine, I'm cool. But who they really want to talk to is the trader, because that's the person taking the risk and seeing the client flow.
Yep.
Hedge funds are a great example. The payout ratio for making, say, $100 million at a hedge fund is much higher than at a bank, okay?
Yep.
You can make that much in profit trading for a bank, and you're going to get paid out a teeny tiny fraction for your bonus because, again, your profits are being distributed amongst your 100 best friends in the division. If you're a great trader at a bank, you might be cutting your teeth there with the ultimate goal of moving to a hedge fund and trading there.
Yeah. And I mean, Jen, we have seen countless junior traders grow up and then switch to hedge funds and make enough money to retire, right? That's where before the age of 40. I mean, the Citadel last year made there was $16 billion for the fund, which means the traders, they probably did pretty well.
Yeah. And listen, that can feel bittersweet for the bankers who are left behind. Listen, if any of these people are listening and you know who you are, we love you and we are not jealous at all, we swear. But listen, just remember the potential downside is much higher at a hedge fund too, okay? If you have a crappy year trading at a bank, as long as you didn't do anything terribly wrong, you are still guaranteed your base salary, and hopefully you live to fight another day the next year. One wrong move at a hedge fund and you can be fired from 1 second to the next.
I mean, or the hedge fund could blow up,
right?
Even if you were doing everything really well. I mean,
not that you have any experience with that. Now listen, for salespeople, exit opportunities aren't quite as clear cut. I mean, don't get me wrong. A lot of the best salespeople I've known and worked with have transitioned very effectively to the buy side and are absolutely killing it in trading seats. Others are in, adjacent roles that you might not think of, like capital raising and investor relations roles at hedge funds, because those rely pretty heavily on that client relationship skill set that you build in a sales role. Right. Or, you could be like me and you could totally jump ship to another industry like I did with real estate, right? I personally found that my background in sales made for a great transition into another client-facing role. Especially one involving, negotiations and high emotions, right?
Right.
There's nothing a client could say to me that hasn't already been said 10 times worse, okay? But yeah, there's so much you can do coming from the world of sales and trading. It can really open up a lot of doors for you.
Jen, this has really been fascinating. Aww. So as someone who has been around this for over 15 years, I really don't think I understood it until today. So thank you so much. I think
honestly,
our listeners are going to be
I'm so happy
really
when I hear things like that from you and from our listeners. We keep getting feedback that people are finally understanding what their friends and family do all day. Dude, literally, I got a call from a friend who went on a date with a guy in power and natural resources banking. And she was like, I quoted episode 4 to him.
I love that.
I was like, yes.
Oh my God. Well, no, hopefully now. So those of you guys listening have an understanding of banking, capital markets, and sales and trading. At least as far as it comes to fixed income.
Right.
I do promise we will get to equities in short order, but we've done so much of the heavy lifting that it's actually, I think, a lot easier to translate the knowledge we built here into equities. Yes. We call this the upside down for a reason. Equities is right side up. But look, before we get there, we've also been getting just a ton of questions on our social media about interview tips for those of you who are looking to break into the industry. So we are teeing up our next couple of episodes, and one is going to include interview tips for those who are interested in jobs in investment banking.
And listen, for those of you who aren't interested in jobs in investment banking, a lot of people aren't, and that's totally cool. So for you guys, we've also started the first of our interviews with some incredible people in the industry. Yeah. We're going to be rolling those episodes out over the next few months. I'm really excited for those. Oh, and we have one other awesome episode we're working on in response to listener demand. We're going to share some of our, I don't know what to call, war stories. So we both had a front row seat to the collapse of the financial services industry in 2008. And we've gotten a lot of requests from people asking us to talk about what it was like to live through that. Yeah. So we're going to share our perspective and our collective collective trauma from 2008 with you.
Especially because I think a lot of people who are younger right now who haven't like seen that before, they want to know what it was like the last time. So,
Right,
I mean, look,
there's
there's
so much
literally a
turmoil right now.
bailout. Yeah, there's a bailout being discussed for First Republic. So figured it couldn't be timelier.
That's right. Well, listen, thank you so much for listening, guys. Keep the questions coming. And if you're enjoying our podcast, please leave us a 5-star rating and in a written review. That would be such a huge help. We love you all.
Thank you, guys. Bye. Thank you so much for listening to The Wall Street Skinny. We are more than just a podcast, so follow us on TikTok and Instagram at The Wall Street Skinny. If you're a visual learner, we have content that will help get you up the curve from valuation to Excel to bond fundamentals 101. And if you haven't done so already, please subscribe to our YouTube channel where we will be publishing in-depth tutorials on all this and more.